All right, we are live with the June WREIA meeting. I'm going to give everyone a few minutes, hopefully, to come on in and join us. Something we've learned about online. People kind of come and go as we do these meetings. The good news is people do seem to take a look at them over the course of the month, and hopefully, we're giving you some information that you can use in your business. So I'm going to click over here, as we've always said. As you come on into tonight's meeting, if you want to say hello, that's great. Also, certainly we encourage anyone to have that has any kind of questions to please go ahead and type those in and be happy to answer those. Dominic, you're a good man. You're always the first one that opens the door. Hopefully, you're learning a few things. I know I'm learning a few things from you as well. So, thanks for joining us tonight. We're going to be talking about a subject that we really haven't discussed. I went through kind of last few years of our REIA meetings, and we really haven't talked too much about the financing angle of real estate. I thought that would be a good time to kind of dive into that as kind of our market changes. So give everyone a few minutes here to come on board, and we'll get started tonight. As I open up tonight's meeting, I kind of want to start it off with a question that I receive quite a bit. Many of you know, I've been doing this now for many years. Coming to you tonight too, as I look in the screen, a little bit casual tonight, which is a great thing about online. Sometimes we can be a little bit casual, so hopefully that's okay with everyone. Magdalene, good to see you. Belinda, good to see you. Learn something or get a refresh on top of each time I tune in, whether live or later during the month. Well, thank you, Belinda. That's very, very nice. Lemma Bryant, hello to all. Very good. Good to see you. I was just saying, I was going to start off tonight's meeting with just a question that I received quite a bit, because I've been doing this now for quite a while. So I've seen markets. I've seen markets that go up. I see markets that have gone down. I've seen markets that are steady. So I've kind of seen, been around, 25 plus years. So I know how it is or how it feels to experience different markets. And I think all of us can agree that the last really 5 to 7 years, but let's say since the pandemic, the last 2 years has been kind of a crazy ride in the real estate market. I mean, values have really gone up tremendously all across the country. And certainly in our area, we have witnessed that too, all across our region. And if you had a house and you had a house to sell, whether it was in great shape or whether it needed a little bit of work, you could really sell that house in a very, quick time frame. Usually in a weekend, you might get 2 or 3 offers. If you had a really good house, it was priced well, that was renovated, shoot, you could get 50 people through in the weekend, and you could end up with 7, 8 offers by Tuesday. So it's been kind of a crazy market. And don't let anyone tell you that they predicted this or they saw this. I don't know if anyone quite really saw this coming. But as we've gone through this, and as inflation has kind of kicked in and the Federal Reserve has started raising rates, I think everyone knows, if you're following the news at all, that they have risen kind of, somewhat dramatically, where they're kind of staying around that high 5-6% range. So what that's done, obviously, it's made housing less affordable. Okay, so basic economics tells you that if interest rates are at 3% and you're buying a $300,000 home, that's better than if interest rates are 6% and you're buying a $300,000 home. So clearly something has to give a little bit. And again, I got out of the prediction business in 2008. I have no idea, really, to tell you the truth, where the market is going to go. I don't think any of us truly know. But if we kind of put on our thinking hats and we kind of look at the data, we can kind of predict that we should go into a much slower part of real estate in the next X amount of years. Now, there's big talk about, will we go in to a recession? If you read a lot, and sometimes you got to be careful to guard yourself against some of these pundits, because as I said, I don't think anyone really knows. You can make predictions, and negative news sells. But a lot of people think we will go into recession. Some people think we're already in a recession. Some people think that we'll avoid a recession, that we'll have a soft landing. Hard to know. But I think we can all agree that it probably won't continue to rise as it has last few years. It cannot. I mean, it's gotten a little bit crazy. Our incomes have to be able to keep up. And some of these values have been inflated because the interest rates have been historically low for so many years. All right. So Russell's always our good news member, and I love reading his quotes because they're always good news. First, the stock market will drop 40%, and next is crypto, and then real estate is a fun of domino. So I always like Russell. He always likes to think that the world is going to end tomorrow, and he might be right. I mean, he might be right. I mean, the real estate market has, I'm sorry, the stock market has gone down. If you've invested in crypto, like Bitcoin and so forth, and some of these other coins, I mean, they have dropped dramatically and wiped out, hundreds of millions of dollars of wealth. So, he predicts real estate will be next, and it very well could be. But the question, long answer, try to get everyone kind of tuned in here tonight. Is the question is do I prefer or have I done better in my career in my business when the market is going up or when the market is going down? Before I answer that, let's also read a little bit more from Russell. Russell, keep it coming. I always like your comments. The definition of recession is 2 quarters of negative growth in a row. We were negative first quarter. Estimate the Fed is 1%. So yeah, some people think that we're already in a recession. Okay, so again, we kind of look back to look at as he said 2 consecutive quarters of negative growth. So we'll see. We'll see. So the answer to my question is, what do I prefer? What do I do better? Well, my answer is going to be a little wishy-washy. I don't think there is any one strategy that I prefer. It is wonderful when houses are selling in weekends. I mean, if you can continue to put your hands on houses, you don't have to do nearly as much work. You put them on the market, you feel like a rock star because everyone's calling you and they want your house and they're willing to forego home inspections and they don't care about appraisals and they'll overlook, dated cabinets or windows that don't close. And it's great. And on the flip side, when a market is going down or when the pundits are saying a lot of negative news, there's opportunity. And we've all heard that there's opportunity. Sellers are the last to realize this, but there's opportunity to negotiate harder. There's opportunity to get really good deals. There's opportunities to maybe put a few more rentals in your portfolio. There's opportunities for bigger deals. There's a lot of good things that can happen when a real estate market isn't tremendous. Now, the challenging part is in the middle. The challenging part is when the market's been really good, like it's been, and then all of a sudden, as we go into summer and we go into late summer and fall, if the market gets slower and slower and slower, if you have a lot in your pipeline, getting through some of those projects can be a little bit painful. Because now when you put your house on the market, and I had one recently, very bread and butter house in the suburbs of Prince George's County, 4 bedrooms, 2 baths. If I had this house in the market in February, March, I would have had 7 offers. And I was asking $420 for the house. I bet I would have gotten $435, $440, no appraisal, no home inspection, nothing. And the house sat for a while. And when houses sit as investors, that's tough. They become vacant. They get a little stale. Your mindset is off that house. You're off to the next deal. Sometimes you have to worry about theft because it's vacant. It's sitting there. Sometimes you obviously have to keep the grounds and landscaping up. You have weeds in the garden. When you first put it on the market, the house should look pristine. But as it goes for a few weeks, you have some weeds. Your guys that maintain the house might not be as diligent or as you would like, and the house looks, not as quite as good as it did even 3 or 4 weeks ago. So, utility bills start adding up, or God forbid, you might have a leak in a house. In fact, I went by a house. I had Laurel. And you'll do this if you've been in the business for a while. I was sleeping soundly, and I kind of woke up at 4 o'clock. And I had this funny feeling. I had an appraisal happening that day, and I just thought, you know what? I haven't been, and I don't think anyone's been in that house for a week and a half or so. I better get up this morning and just run over there just to make sure everything is good for the appraisal. And I went over there, got over there very early, about 5:30 in the morning, walked in the house, kind of walked through the main floor. Everything looked fine. Air conditioning was running, went downstairs. Everything looked great. And I was about to leave and said, well, I better just run upstairs to make sure everything is good. And I did. And I walked into the master bedroom. And lo and behold, the master bedroom had a jacuzzi tub. And there was a small drip in that jacuzzi tub. Drip, 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 drip. And literally the water was at the rim of that jacuzzi tub. And I tell you, if I would have left that another 1, 2, 3 days, we would have had a major, major headache on our hands. Because as you know, water can do some tremendous damage. And so things like that, when houses are vacant and they sit, that's challenging. And so that's why it's wonderful when houses just move really, really quick. You can move the capital really fast. You can keep your crews moving. You don't have to always worry about, that house kind of lingering. And I've been doing some deals with Dominic Lord. Dominic's on the line now. And one thing I told him, as the market slows down, you start stacking houses, meaning as you finish houses and they don't move immediately, now all of a sudden, if you're a real active investor, you might have 3, 4, 5, 8, 10, 15, however volume you're doing, starting to stack up. And that slows the whole process down. You have to worry about some of those houses. You have to start lowering prices. You have to get through those. You have to make sure that everything is going along. And it's hard sometimes to start new projects when you have that much in the pipeline. But on the flip side, the slower market does lead you to opportunities. And I think if you talk to any experienced investor, they'll tell you that they've made a lot of money by being patient, by looking for those nuggets, looking for those opportunities, looking for those times where the market is slower and you have the ability to negotiate and you have the ability to find some really, really good deals. So my answer is, I think you need to be prepared for both cycles, because if you're in this business long enough, you're going to be investing in an up market and you're going to be investing in a down market. And if you think you can time everything and sell at the up and just hold in the down, not always how it works. It's not like pushing a button on the stock market. But I think we're headed for certainly a slower real estate market, which is not a bad thing, which had to happen. Houses can't keep going up 13, 15, 18, 20% a year. We just can't afford them. So hopefully that helps you a little bit. Let's go back to our local economist, Russell Bird, and read a few of his comments. Stated CPI, 8.6, 1.6 Fed funds interest rate. So basically, to break inflation, Fed would have to raise 7.5%. Federal Reserve Chairman won't do that. Collective inflation, expansion of money supply, chasing semester checks. We had explosion of currency in 20 months. Certainly, we had a lot of money supply go into the economy during the pandemic. Some people would argue if we didn't, we would have gone into a major, major depression. But we certainly did. We had a lot of capital go in. And then the true inflation rate is at least double the state of 8% investing in a depression. Inflation. No one alive can relate to investing in a depression, John. Yes and no. Yes and no. I do believe. Okay, Russell, if you can read some of those. Russell's got a lot of opinions, and that's fine. And no one's saying he's right, and no one is saying he is wrong. When he says no one alive can relate to investing in depression, that certainly is true. I don't think anyone on this Zoom meeting tonight was around in the late 20s. At least I don't think so. But some of us experienced, some pretty tough times in 2008, 2009, 2010. I personally had, 33 hard money loans out there that all went sour and all went upside down. I can tell you it wasn't a depression, but there were days where I didn't think I'd make it through. But sure. And, there is a lot of doomsdayers out there. I mean, whether you are on this in a political show, but whatever, side of the aisle you're on, there is a lot of polarization in this country, and there's a lot of differing ideas on policy and how we run a country and so forth. So, I don't think any of us, hopefully, are not entitled enough to understand and believe that a depression or a deep, deep economic slump could not happen. It certainly can. I'm just from the mindset that if it does, and you are prepared, educational wise, mentally, maybe spiritually, if you go that way, there's going to be opportunity, and you have to believe that. That's why I try to read a lot, but I also stay away. I understand that the world is a global economy, but John Peterson, the Peterson family, we have our own little economy, and we got to day by day focus on that and focus on what we can control and focus on what we can do to offset different things and continue to try to build our business and keep our business going and continue in our real estate and investing. So, that is what you got to do. Now, again, Russell's kind of going off, so he's got a lot of comments on here. And again, if you truly believe that, I mean, if Russell believes 90% of what he's writing, he should prepare for that. he should prepare for the end of times, basically the end of economic times. And there's certain things that you can do to do that. There are other pundits out there that love telling you that the sky is falling. My belief is that you should read it, you should understand it, you should kind of prepare for it. This is not our talk this evening, but understand that usually is not the worst case scenario. It's certainly not the best case scenario. It's usually, if you look at history, it's usually somewhere kind of in between. And I think you can do that. And Russell says he is prepared. So on another meeting, he will let us all know how he is prepared. And you know what? That could be great. There's also people that out there that are what we call preppers, and they have food, they have ammo, they have everything in their basement. And my sister-in-law is a prepper, and she moved recently, and all the food and all the things that she stored for the collapse of the world in 1999, going into the year 2000, they had to throw away. So, you know, that's great. I figure that if the end of the world comes, I know where I'm going, and I'll live with that. So, anyways, on to tonight's meeting. I thought it was a good time, as I started out with some of you joined, to talk a little bit about money and financing, because when a real estate market slows down, and when the money isn't flowing as much, and maybe in your business it's not flowing as much, and again, all this depends on what kind of business you have. If you're a buy, renovate, and sell person, some of those deals are still going to be viable. I mean, I've always, every year, been able to buy, renovate, and sell houses. But in a slower market, as I said, the capital doesn't turn over as much, and you have to have a little more capital to manage those properties, to pay your mortgages and pay your utilities, and so the capital flow slows down a little bit. Maybe you're a wholesaler, so you're able to move houses very, very quickly, but your profits might be a little less than they were in a go-go market where everyone was buying anything that had four walls. Maybe you're a landlord, which is a great place to be. And maybe you can walk through a slower time if you have good, solid tenants. But remember, in a slower economy, hopefully some of those folks can keep their jobs, and some of the cash flow doesn't slow down on missed rent payments, and so forth. So you might have to have a little bit of a cushion. You might have to have a little bit of savings. So if some of those houses go vacant for 2, 3, 4, 5, 6 months, you have the ability to continue to make those payments and continue to walk through this period of time. And so I thought we should talk a little bit about some of the financing options that you might have. I mean, first of all, the best way to approach any business, and I think any successful business person will tell you this, is that you can't spend all your money. I mean, you have to have the ability to have the discipline to put some away for a rainy day. And so when times do slow down a little bit, that you have the ability to weather that and come out the other side. So the point is that when the market slows down, or the real estate market slows down, you have time to look for opportunities. You're not just scrambling all around trying to, rob Peter to pay Paul, but you have the ability to sit back, let some opportunities come, continue your marketing, continuing what you're going after, be very detailed and prepared on what you're going after, and then go after that, but not always having to sit there and, oh, geez, what am I going to do? I can't pay, this mortgage. I can't pay that mortgage. Hopefully you've prepared for that a little bit. But as you do new deals, let's talk about some financing options that you might have, that for some of you, again, this is review. I get it, but it's good to review some of these things to understand them and implement them. And then for some of you folks that are out there listening and you've never done a deal, and you're going to watch this in 2 weeks, you're going to stumble upon it on the internet. It's important to understand these concepts. And again, in a meeting like this, we're giving you a broad view, but these are something that you can really kind of dig in, get more information about, and understand, and then implement. Again, and a lot of you have been around. If any of you need help with any of this, I am available. My cell phone number will be coming across the screen. If you need some help with this, great. I do some one-on-one counseling, one-on-one mentoring. It's very affordable. It's very direct and specific to what you want to do. So anytime you want to do that, feel free to text or call me. But let's get started here. Let's get started with I'm going to go through five, and let's go through with one that's a little bit obvious. I would say this can work in 10 to 15% as the calls come through, as you're marketing out your business, as you're marketing out your service. Again, focused on the area, focused on the niche of real estate investment that you want to explore, whether that's buy, renovate, sell, whether that's wholesaling, whether that's finding good rental properties, whether that's putting together a multifamily deal, whether it's marketing for distress notes, marketing for performing notes, being a realtor, being a loan officer, all the different aspects of real estate investment. As you're marketing out and deals come in and it's something that you want to take advantage of and put either in your portfolio, you want to buy, renovate, sell it, or you want to keep it as a long-term rental. These are some of the things that you can consider. The first one is owner financing. What exactly do I mean by owner financing? Basically, the basic definition of that is a seller. The seller of the property is being your bank. Okay. They are Bank of America. They are Truist Bank. They are whoever, right? They're playing banker for you. They have the ability to play bank. So in other words, you are going to go to them and you're going to ask them for a certain period of time. Maybe it's only 6 months. Maybe it's a year. Maybe it's 10 years. Will they hold a mortgage? Will they hold a note for you in order for you to make those monthly payments to them, in order for you to, go ahead and execute that deal on whatever strategy you're going to work? Now, again, if you don't have a lot of money, maybe you construct a deal with an owner that you can get a pretty good deal on the property, but you don't want to give them monthly payments. Maybe you bulk payment. Maybe you say, hey, a balloon is due every year or once every 3 years. Remember, the great thing about real estate, especially creative real estate, is that there's no rules. There's no regulations. There's nothing saying you have to make every month, you have to make a payment. You construct that deal to make it work for you and for them. The beauty of a slower market is that these folks are looking for you folks. They're looking for creative minds. They're looking for people that can put things together. You're deal makers. You're solving problems, and you have the ability to work those problems to your benefit and the seller's benefit. So always consider asking the owner of the property to finance that piece of real estate for you. And folks, this can work on a small bungalow in Florida. This can work on a 6-unit building in Frederick. This can work on land deals. This can work on a note deal. It works everywhere. If the owner has the ability to finance the deal, you want to find that out. Okay. Now, the profile or the ideal person is generally someone older, someone that's owned property for a period of time. They built up equity. Have we had equity build up in the last 3 years here in the last 7 years in the Washington, D.C. market? If you bought a house 7 years ago in Washington, D.C., or in Seat Pleasant, or in Clifton, Virginia, is your house worth more than it is 7 years ago? The answer is yes. So that buildup of equity allows people, okay, and if someone's owned the house for 20 or 30 years, good chance they might not even have a mortgage, or they have a very small mortgage. So they have the ability to take those monthly payments, if you do it monthly, okay, maybe pay an underlying mortgage and put a little money in their pocket. Or maybe they don't own any mortgage and they're putting all the money in your pocket. Don't discount that people have the ability to owner finance. My greatest owner finance deal to this day, because I kept it and it's done so well, was a property in Georgetown. It was back in 2004. And it's not once off every 16 years. I mean, I ask everyone to owner finance deals. And I would say about 10%, maybe 15% of people, especially in a slower market, are open to the idea. But this particular case came off a lead, and I met the owner, and he wanted $250,000 for this property. Now, remember, this is back in 2004. The house literally was a hoarder house. It needed dumpster after dumpster after dumpster to clear out. But obviously a good solid house about 2 blocks from Georgetown Hospital. And his big thing, deal maker, if you will, was that he wanted $250,000 for this house. He didn't want 230. He didn't want 220. He wanted 250. And so what I did when he kept harping that and telling me other people were offering him 220, 230, said, listen, I'll give you 250, but I want you to owner finance it. No money out of, I don't have any money to give you. I'm going to put it in renovating the property, and I will pay you. Okay. I will pay you a lump sum, $250,000 plus interest. By the way, I offered him no interest and he took it. in 2 years. I wanted 2 years to do that project. I said, good chance we'll be done in 6 months. Good chance we'll be done in a year, but I want 2 years at 250. And he took that deal. He took that deal because he was hell bent on 250. And, I listened to what he wanted. And that deal took us, about 8 months, 9 months to renovate. And we decided to keep that deal. And, I've rented it and I've owned it ever since. That deal today is probably worth $1.3, $1.4 million. And it's rented from day one and not been vacant for even a month. And the rent is tremendous. The rent is roughly, $4,300, $4,500 a month. So obviously that's grown over the years. But just a simple question and listening and saying, will you own or finance it? And will you take zero because I'm paying you max price for this property? Now, in 2004, the market was doing pretty well. And neighbors and people were surprised I could get that deal. But it's just the ability to ask the question. So you got to get educated. You got to understand what's available to you in order to do these deals. Now, we put money into the property. We put money into fixing it up. We had to get that property ready for a renter. So there's not no money down out of our pocket. But in that case, we came up with $250,000, the snap of a finger, by just asking the question. Okay. Russell, yeah, great strategy for homeowner who wants their price. Give them the price, but your terms. Exactly right. In a slower market, that's the good news. When the market slows down a little bit, the owners, the sellers are more apt to listen. You're more apt to be able to cross the living room or the kitchen table and sitting down and putting down on paper and trying to figure out a strategy that helps them get out and helps you make a deal out of nothing, out of thin air. And that's a beauty of real estate. It's a beauty of real estate. The second one I want to talk to you about, and we did an email about this, is called Subject To. Now, I don't know if he's on the platform here tonight, but one of long-term members of WREIA, Scott Gunn, we were talking the other day. And, we're just talking about the market and what he was seeing and what I was seeing. And he talked about he and his partner had picked up 2 or 3 Subject To deals recently to put in their rental portfolio. I've also done many, many Subject To deals in my career. And this is what we're talking about when we mean Subject To. Another word for this is quietly assuming the existing mortgage. And this gets me giddy. This gets me excited in where we are in the market cycle. Because, folks, the last, 5, 7, 8 years, whatever it's been, interest rates have been historically low, ridiculously low. All right, so low. And so many people bought houses, obviously, with rates of 2.5%, 3%, 3.5% for 30 years. I mean, that's literally giving away money. So now, as the market slows down, and some of those people have equity buildup, their houses have grown in value, but maybe they've taken a second mortgage or whatever the case, but now they want to sell. And they can't just hire the local Compass realtor and put it on the market and have it go in a weekend. They need to sell. They're motivated. Remember that word, motivated. We talk about it often. They're motivated. They're ready to go. So now you come in as a white knight. Now you're marketing to these people. You're marketing that you buy houses, that you hold houses for rentals, that you wholesale. You're marketing to them. So as they call you and you sit down with them, the perfect scenario with this, and this works in all scenarios, but the perfect scenario is, let's say their house is worth $380,000, $400,000. And again, we're in the lower price brackets, but this still works in higher priced homes. And they have a mortgage. Let's say they have $80,000 of equity, but the house needs a little bit of work. They've been hard on the house. And they just want out. They're ready to go. Something's going on in their life where they want to sell this house. And we've talked about this at WREIA meetings before. All the reasons people sell houses below market. Because as you get involved in this business, and if you are involved in this business, one of the questions you're often going to get from maybe your spouse, maybe your partner, maybe people that you meet at a party is, how do you get these houses so cheap? That's probably the number one question I get. Why would they sell it to you so cheap? And I always say, they're motivated. There's something going on in their life that motivates them to sell the house. And generally, the houses we buy need work. So let's say there's that $80,000 of equity, but it might need $15,000 or $20,000. But they have this sweet mortgage that has 24 more years at 3% interest rate. So a Subject To is literally buying that house subject to that mortgage. You're taking over. You're quietly assuming that mortgage. Now, the key is maybe you're going to fix it up real quick and try to quick sell it. That's fine. You pay the mortgage during that time. or in some cases, because our rents have risen in the last 2 years. Rents have gone higher, and I believe they're going to stabilize because rents don't come down as quick as housing prices. They just don't. And they might even go a little higher. If people have a hard time affording houses, more pressure on the rental market. But because of that rise in rental rates and the ability of these houses to have such a low mortgage rate for 30 years, you might be able to pick up some really nice rental properties that make sense. Now, maybe they won't be $1,000 monthly cash flows, but they could be a couple $100. You might have some equity involved in that house. Plus, the beauty of it, folks, you're not qualifying for the mortgage. You're quietly assuming the mortgage. This is legal. You don't have to worry about it being illegal. The bank in their paperwork still has the right to call that mortgage. But as long as I've been doing this, I've heard one or two people that the mortgage has been called on. Banks don't care who make the mortgage payment. You continue to make, if you want to make my mortgage payment in July and August and September, October, they don't care. And it's great for me. If you want to, go ahead and let me know. They don't know where the money's coming from and who's paying whose mortgage. You still own the house. You have a deed in your name. You keep the existing insurance policy on the house and you get a new one in your name. That's a key thing. Remember that if you're doing subject twos. And if you get involved in this heavy, take a little consulting from me, take a little mentoring from me, or get a little more information about subject twos. There's some little bit of caveats in this that will protect you and allow you to do this at will. Imagining picking up 3, 4, 5 good rentals in the next 12 months. Folks, as real estate markets shift and change and we get back into a growth mode, that might not happen for a while, but when it does, and you've all seen it, those houses rise in value and you're babysitting those homes until they rise in value. And then when they do, you can sell them for chunks of money, got to pay taxes, or you can do 1031s and you can vault your portfolio into higher and better real estate. So folks, this is how it works. This is why it's not get rich quick in real estate investing. Sure, you can make some money fairly quickly, but it takes time to get rich. But it's available. It's a vehicle that the average person can implement with a few strategies and do very, very well. Understand how to do subject to mortgages. It's a great vehicle of taking over tremendous amounts of money, okay, with no qualification. It's a signature on a page. Why would the seller do it? The seller's doing it because they're motivated. They want to get out. They'd rather have someone else be paying that mortgage. And you can sue them and you can show them verification that you're making those mortgage payments. Great strategy, great thing to understand. And it's going to be just steamrolling in the next few years because of all the cheap money that's just been given out right and left to a lot of folks. So remember that owner financing is subject to. The third one, and we've talked a lot about this. All right, Russell's got another comment. Russell, I appreciate you bringing this on. Another way to make John's deal better is to have 2 or 3 notes on the property, one being at least 5 years, and have the ability to move the note. Yeah, well, we're not going that deep tonight. Technically, subject to is non-recourse loan, meaning you can't be sued if the house goes up. Always gives the seller CYA a letter for the mortgage. Certainly, yeah. There's, as I said, there's caveats to this that you need to understand, but put that down in your notes, subject twos. The third one we talked about quite a bit at WREIA over the years. Great way to finance properties. I do it on both sides, and that's partnerships. Folks, partnerships are one of the things that you really need to delve into and to focus in on and to understand because they can be your ticket to tremendous upside in real estate. So again, this is how it works, depending on which side you're on. Maybe you need capital, and that's what we're talking about tonight. So we're going to come at it as we need capital. You need to go find other people that have capital and they want to get in the real estate business, but they want to get their hands dirty. They're not going to go out and look for deals. They're not going to work with contractors. They're not going to find property managers. They're not going to, go buy the house and check on it. They just have capital. All right. And you can partner with folks. Now, where do you find these people? Well, folks, these people are everywhere. All right. They're everywhere. And you have to advertise. You have to network. You have to start getting your 2-minute elevator pitch going that you are looking for people with capital, people with money that want to partner with you on a specific project. Maybe it's a rental property. Maybe it's a wholesale deal. Maybe it's a buy, renovate, and sell. Now, why would you need money on a wholesale deal? Maybe you need an earnest money deposit. Maybe you need a little capital behind you for some letters to throw out to sellers to make them comfortable that you can close. You always need capital. In fact, the two things that you should be focused on most in this business and mostly any business is finding deals, right? And let's say you're not in the real estate business. Let's say you're in the computer or software business, finding, applications for your software, finding clients, our deals, our houses, our apartment buildings, our notes or whatever. And number two is finding capital. Those two things should be front and center in your mind every single day as a business person. Finding new business, finding deals, and finding capital to finance the growth of your business and finance the ability for you when you find those deals, that's the ability to perform. And finding partners is one of those key things. Now, I'll tell you, back in 2012, 2013, I tried this in 2011 as I kind of got through some of my issues of finding capital partners in order to buy up some rental properties. And some of you might remember, if you've been around that long, it was the road to 100. I tried to buy 100 rental properties. Everyone saw the prices so low, so depressed, banks giving away houses. I knew, and the rents were starting to work where they hadn't worked in years before, that if I could find two very strong capital partners or one strong capital partner, I could make a lot of money buying rental properties and holding them for a period of time as we came through that cycle. Well, I finally convinced two people to do it with me, and we didn't get to 100. We were late. We bought these in 12 and 13, and I had a specific target, specific analysis, specific way that I wanted to have equity going in. I wanted a certain cash flow, and I had the ability to buy 25. Well, we've been through that cycle, and lo and behold, in January 2020, one of the partners decided it was time for him to exit, and he wanted to sell as leases became as expired. And we've gotten through all those, but basically 3 houses. And folks, the returns have been phenomenal. And we've done very, very well in that portfolio. Well, guess what? It's happening again. Here we go again. So if you can find people to buy some rental properties right now, maybe a small building, maybe a commercial building, everyone's down on commercial, no one's going back to work. E-commerce is going to take over. But there's still some great assets that are going to be available to you that still work. So it's time to find those partners, to do it. And it's just not partners, you can partner with a contractor. Maybe your electrical contractor has money. I know mine does. Maybe your plumber. Maybe a vendor has money. Maybe someone that you work with on a daily basis, you don't even realize that has money. Maybe partner with other investors, maybe another real estate investor. Maybe they need a few more deals. The beauty of partnership is that you don't have to be responsible for everything. You can focus on maybe what you do best. Pick the part you do best and find those other partners to offset. A lot of cases, we need a partner to have capital. Now, my deal with the rental property, my 2 partners put up all the money, all of it. They qualify for the loans, any maintenance, everything. I got paid finding the houses, I got paid managing the houses, and I got paid an equity position of selling the houses. It was a great deal for me. And it was also a great deal for them because they needed someone like me that had the ability to find really good deals, that could analyze them correctly, could manage them effectively, and get rid of them in a timely manner. So it was a good mesh of partners. So partners can be a key. Let me just go through a few of these things. You're not responsible for all aspects of the the property. Each of the parties is sharing the overall risk, which is nice. I mean, maybe you can handle 2 or 3 properties on your own. Maybe you have the resources or the ability to do that. Maybe one's an owner finance. Maybe one's a subject to, but you come across 2 or 3 more opportunities. That's your way to expand, to grow, to expand out of an area. Maybe you're all keen and all excited to start investing in Indianapolis, Indiana. Find a good partner out there. Maybe someone on the ground. Maybe you find some capital here. I mean, there's endless things you can do with partners. You got to be careful. You got to make sure that you vet your partners, that you get along with your partners, that each of your partners has the same vision as you, that you layer it up, meaning paper it up with lawyers to make sure that you have a simple agreement together with that partners. A lot of I've built a lot of my business on partners. I'm doing a partnership in Bladensburg recently. I do some partnerships with Dominic Lord down in Southern Maryland. I have a partnership going on in a property in DC. As I also have partnered I also have deals that, the JVN that my own company is doing with my own crews and so forth, but it expands me. It allows me to do more things. So I'm a big advocate of partners. If you need more help with this, if you want to walk step by step how to identify these folks, how to find the right partner for you based on what you're trying to do and accomplish in the business, again, reach out. My cell phone will be on the screen a few times. There it is. More than happy to discuss it with you. I have a very simple 3 1 hour, basically 3 hours, 3 1 hour sessions. We can do online. We can do in my office. It's very affordable, folks. I charge $500. So if you want to do any of these things and you need more help and more kind of hand holding, reach out and let me know. All right, owner finance, subject to partnerships. The third one you've heard me talk about before if you've been around at all, and that's creating your own bank. That's creating a private bank. And basically that is taking your partners, your capital partners, the people that have capital, and you're basically taking on more of the risk. You're taking more of the risk. Now in a partnership, you might structure it a lot of different ways. Maybe someone getting a preferred rate of return. Maybe they're getting 5% return on their money. And when the profits come up, you're splitting them 50-50. Or you're making more, they're making less, however you come up with it. Same will apply to losses. Now in a private bank scenario, you're taking that same capital. People within your network, start within your network. Think of 5 people that you can approach that may have capital or more importantly, may know somebody with capital. Okay. May know somebody. And if you don't know anyone and they don't know anyone, I often say you need new friends. You need to network more. You need to find people with capital. But with that private bank concept, all that we're doing is we're flipping a little bit. We're saying, hey, here's a return on your capital. I'm taking the bulk of the risk, right? They might make 8, 9, 10, 12% return on their money. But they're going to be conservative, right? They're going to make you take the risk. You've got to go renovate that property or go get that property ready for rental and refinance it. You're taking on more of the risk. And some of the examples in the email, it's one of the ways I've financed a lot of my real estate, just building out that network. And people come and go. I mean, I've had people for many, many years, but I've had people too. As I'm getting more experience in my business, remember, they've gotten more experience in their life too, and they don't want to lend money anymore. They're off in Florida fishing, or they're playing golf in Costa Rica, or they don't want to do it anymore. So you're constantly always trying to kind of keep your ears to the ground and trying to come up with these new sources of private individuals that have capital that want to invest. Listen, this is a simple procedure to set up this private bank. It takes work, it takes time, it takes networking, it takes some packages, investment packages, if you will, some background on you. But it is the best way to finance certainly short-term real estate. Now, I've also morphed into using some private individuals, and I throw this out to you too, for longer-term holds. Okay, I recently had a tax-free exchange and identified a great property that had great upside, good rental potential, some equity. Had the ability to buy it, fix it, get it ready for it, and have some good equity. And I got caught in between kind of this interest rate surge, and the bank or one of the banks was usually kind of jacked it up, and they wanted X amount of documents and all these things. And I was under the gun because I had a 1031 tax-free exchange. And so I went, networked, and got a few referrals to a couple different people that were willing to hold paper, that were willing to give me a loan for 3, 5, 7 years. And I've used a few people for this strategically. Now, their rate was not hard money. Their rate was not private investment capital. Their rate was fair. It wasn't cheap. It wasn't 4%, but it wasn't 10, 12% either. The reason that I took it is, number one, I had to protect my investment with the tax-free exchange. I had a good amount of equity in the new house. I had a tremendous rent, so the cash flow was real solid, much better than the house that I sold to get into this deal. And so I took it. I'm paying a little more than I want, but overall, it still met my goals, met my objectives, and I'm committed to them for a minimum of 3 years, and I have up to 7 years. Now I can refinance it after that, or I could sell the property and do another tax-free exchange. But again, it's capital that I didn't have to qualify for. It doesn't show up on my credit report, and it's a good relationship. So if anything ever got in trouble, I'm sure we can work something out. So it's a good win-win for both parties. So you can still use private capital for longer term loans. Now, most individuals aren't going to give you a 30-year loan unless they're a relative or something, but you can find them for 3, 5, 7 years. It takes some work. A lot of people don't want to tap their money, but if you give them a nice return, single digit return, and show them that the property is solid, that you have the ability to pay their mortgage through your rent, obviously, it's a good alternative. So you're always looking to that private world for capital. And I don't care if you're just starting out. When I first started out, my very first buy renovate deal was with a private individual. And, I was excited, and I showed up on time, and I showed him that I did my analysis, and I walked him through the house proudly and said, this is what we're going to do to make it worth this. And this is what it's going to be worth when we finish. And even though it was my first time, they saw the enthusiasm, they saw the work ethic, and they gladly loan me the money. So don't give me the excuse, I don't know, I'm too new. Well, get educated, get some people around you, get a mentor, get a good circle of friends, and you can begin doing this with other people's money. And then finally, the last one, and again, if you have questions, feel free to throw them out. But the last one is hard money. There's a tremendous amount of money out there for real estate investment, more than there's ever been. And hard money ranges now. I mean, some of that capital's come down because of competition. Like an area like Florida, for example. I mean, there's so many older people that want to lend hard money. The rates are actually pretty reasonable. So you look around, you interview those hard money lenders, you find out what they need from you. You find out what capital you might need. And again, you can implement, right? You can implement other sources of capital to satisfy them. So let's say a hard money lender, say we had a deal of $400,000. We were buying it for $280 and we needed all the $280. We don't have a lot of money and we needed $40,000 for fix up. And the hard money lender requires us not only have the $40,000 in fix up, but we also have to have $20,000 down. They'll loan us $260,000 on that deal. Well, you got to come up with $60,000. Where are you going to come up with that? Maybe you have a line of credit in your house. Maybe you have some credit cards. Maybe you bring in a partner to put up the $60,000 and you give them a piece of the deal in the back end. I know some of these deals are getting chopped, okay? But that's okay. You have to continue to be looking to make money during some of these slower times. So sometimes you're willing to give up some to make some. It just makes sense. Call around, Google it, network it. They're really everywhere. I would try to stay more local, and local means broadly the DMV area. There's certainly some regional, there's some national hard money lenders. Take some time to just, fill out some of their forms, give them this is a typical deal that I might have. What happens when I get the deal? What can I expect from you? All those things. Get prepared now before you have these deals, because the deals are going to come. The deals are going to flow. You're going to see it. You're going to see people drop away from the real estate investment business because the easy money is gone. They don't want to hold houses for past a weekend. Some of them have been paying way too much for their houses. So when they don't sell on a weekend and they have to, I've heard people complaining, I've had this house for 6 weeks. I don't have a contract. Folks, that's nothing. That's nothing. I mean, we might go in a period of time, as Russell thinks, where we might be holding these houses for 3, 4, 5, 6 months. I hope not, but it's possible. I haven't seen that, and I don't believe that's going to happen, quite honestly. I do think it's going to slow down. I don't think we're going to have huge price appreciation, but I think if you have a good house priced accordingly in good shape, you're going to be able to sell that house in a reasonable amount of time. I still believe that going forward. And if the whole bottom falls out, then we'll have to, hopefully, as we're identifying our new deals, we have multiple options, multiple strategies to get out. Maybe we'll have to hold a few more houses. Maybe we'll have to hold them for a few more years, but that's okay. And then finally, too, always look for, in a slower market, how you can benefit that seller. That's really key. How can you use your skills? How can you use your network? How can you use your contacts to help that seller, but still make money? Maybe you're not even buying that house. Maybe you're going into that seller. I've had dozens and dozens of these, and actually they're my best deals, where I come in and they have some equity. They don't have a lot, but they need help. So you go in, you help them renovate the house. You make a fee for that. You're up front. It's a contracting fee. If you have a real estate license, you could maybe market that house and list that house and make a fee. All right. Maybe there's underlying debt in that house. Kind of what Russell said. Maybe there's a second or third mortgage and that has the ability to pay off and you can buy that at a discount. There's lots of different ways to make money on this real estate transaction. And you have to get educated and get out there and start talking. So when people call you, you then have a solution. My partner, Dominic, down in Southern Maryland, one of the things that he's been setting up, we've been talking about it quite a bit, is that there will be short sales coming and he's starting to see some in his marketing. So he's not an expert in short sales, but what he's done is he's teamed up. He has a resource, he has a referral link to someone that has a short sale machine. I mean, they have it down to a science. And so he, as he gets leads and he's visiting properties, he determines through going through his analysis that, hey, this is not going to work for me. I can't use it as a rental. I can't wholesale. I can't buy, renovate, sell it. You're probably going to have to do a short sale. I have a great person I can refer you to. And as he refers that to him, then as that short sale takes place, Dominic can circle back and be that buyer. But he set that up already. And that's brilliant because we haven't had a lot of short sales in the last few years. At least I haven't. But as those come and you have a resource for that, you don't necessarily have to be the expert and do all of that, but you have someone you can refer that to. And now is when you want to set that up. Right now, as we start this process, this cycle, whatever's coming is going to come. We're not going to stop it. We have to get prepared and we have to get moving so we can continue making money in real estate. So alternative financing. I mean, there's many, many other ways. Putting together a few credit cards, even though the rate is going to be higher on those for, non-signature loans. Talking to your bank about lines of credit. Talking about existing lines. Are they going to pull those? Be prepared. They might pull those. I mean, in the last go around, I had a $250,000 line of credit, Wells Fargo. Overnight, they dropped it to $50,000. Okay. I wasn't smart enough to should have taken out $249,000 of that and, paid it back over time. But you got to be prepared for some of these things. Talk to family and friends. Maybe people have a little capital they can set aside to help you with a renovation, to help you get a property ready for rental. Our rental rates have been great, and it allowed us to make sense of some other properties. And maybe it's not right here in Washington, D.C. Maybe you have a connection to a different market around the country that makes more sense for rental properties. Think about it, as those markets slow down. Okay, as those markets slow down and rents really work and sellers are more desperate to sell, you can carve out some tremendous opportunities to get some very good rents at a reduced, if you will, real estate on sale time. So lots of ways to go with that. So owner financing, subject to partnerships, private capital, and hard money. And when you think about it, it all revolves around people and all revolves around network and all revolves around you talking about your business and talking about what you need. You need deals, you need opportunities, deals, and you need capital. And so get that in your DNA. Talk to people, as you're at parties or at events or at business meetings or, in your neighborhoods. Just get used to talking about what you're looking for and what you need. And you'll be surprised at the meetings and the opportunities you have. If you need any help with this, okay, you have my cell phone. You've seen it on the screen. It'll come up again here. Give me a call. If you have a question or two, no problem. If you want, again, a little bit of mentoring, a little bit of get started, a little bit of kick in the butt, and I can help you for a very low price, I can do that. And I'd be more than happy to do that. And hopefully maybe we can partner on a deal, or I can provide capital for you, or you can provide capital for me. We have hard money lenders in our network. We have people in our network that have money that are looking for opportunities. So just reach out to folks, let them know that you're there. And that's my call out. If you have capital you want to invest, text me. If you're looking for a partner, text me. More than happy to see if I can do some more deals with you folks. I hope this was helpful. It's hard to believe that we're 6 months. Okay. We're 6 months into the year. As many of you know, we generally meet again in July online, and then we take August off. This year, I'm going to have the sad journey of taking my last son to college, which is going to be extremely difficult. My wife and I will be empty nesters. I just enjoyed my kids a lot. It's going to be tough when they're both off and running and, hopefully living their lives. But I got to do that in mid-August, take him to college. But then we'll be, again, back in September and running some of his line. If you have topics, as you said, if you hear about people that you think might be interesting as a group, we're always listening to, you're always interested in other topics, feel free. I was kind of reading another one of the comments. I have to say, John Peters is a pretty good partner. Well, thank you, Russell. Russell say you can get a 5 to 7 year private loan amortized over 30 years, so your mortgage payments are lower. The final payment is a balloon, so add a year, etc. if you pay a fee. Absolutely. Again, the beautiful thing, and obviously Russell has been around, and some of the folks that are listening have been around a little bit. And he is, thank you, Charlie. Good to see you, Charlie. I'd love to talk to you soon, maybe have lunch somewhere. And some of these comments is that the great thing about real estate is it's whatever you come up with. You structure the deal where it makes sense for you. Structure the deal so you can handle it. Structure the deal where the property makes sense, and you'll be amazed at what you can do in this business and the amount of wealth that you can create out of thin air, out of nothing is amazing. And that's really the benefit of a slower market. That's where you see kind of the education, the more experienced guys kind of dig in and dig their teeth in and get excited, because that's when they have a little bit of the upper hand. Their negotiating skills come out, their creativity comes out, and the sellers are open to this because you fill a need. They can't just call the locus compass agent anymore. They can't just, because those folks don't know this stuff. That's not what rightfully so. That's not what they do. They list houses, they sell houses. They haven't taken the time to do a lot of creativity around their business. But sometimes markets force you to be a little bit more creative. So again, I hope this helps. If we don't have any more questions, we're going to sign off here tonight. Enjoy this summer. We'll be back with you in July. Folks, I'm around. I'm active. I bought 4 houses this month and looking for more. So let me know if I can help you, and let me know, what we can do for you all in the future. Thanks for sticking around and sticking with me. And I hope everyone is doing well. So we'll talk to you soon. Take care. Thanks for joining us tonight.